Imagine this. You wake up every morning in retirement, and instead of worrying about whether the stock market is up or down, you have cash flowing into your account every single month without selling a single share. That's the power of dividend income. For years, the traditional advice has been to withdraw 4% annually from a growth-focused portfolio, but I choose a different path. One that lets me live off my investment without ever touching the principal. In this video, I break down why I choose dividend investing over selling stocks, the risk and benefits of each strategy, and how you can create your own passive income retirement plan. Let's dive in. Before I made my decision, I had to understand the two most common retirement strategies. The first one is annual growth withdrawal, the 4% rule. You invest in index fund or growth stocks and withdraw 4% of your portfolio per year to cover expenses. Historically, this works as long as the market keeps growing, but in a downturn, you may be forced to sell assets at a loss. Dividend passive income. You invest in high quality dividend stocks and ETFs that pay you regular income without selling anything. Instead of worrying about market swings, you live off the dividends your investment generate. Both approaches has their merit, but here's why I went all in on dividends. The 4% rule sounds simple. Withdraw a fixed percentage every year and your portfolio should last. But what happens when the market crashes? In 2008, the market dropped nearly 40%, forcing retirees to sell stocks at a huge loss just to cover expenses. In 2022, the S&P 500 dropped over 20% again, hurting those relying on stocks withdrawals. This is called sequence of return risk, meaning if you start withdrawing during a bad market year, you could run out of money much faster. That's what made me ask, what if I could cover my expenses without ever selling my investment? That's where dividends comes in. Here's why I built my retirement plan around dividend passive income. They are reliable cash flow. My dividend portfolio pays me every month or quarter, so I never have to sell shares. No market timing worries. Whether the market is up or down, I still get paid. Growing income over time, meaning dividend stocks increases their payout every year, meaning my income keeps rising with inflation. For example, let's say I own $500,000 in dividend stocks, yielding 4%. That's $20,000 per year in passive income without selling a single shares. Now, let's compare this to the growth withdrawal method. Growth withdrawal strategy works well in bull markets, risky during market crashes, income dependent on portfolio value, you might outlive your money. Dividend passive income provides steady, predictable cash flow, no need to sell assets, dividend growth beats inflation, your portfolio remains intact. For me, the choice was clear. I wanted a financially stress-free retirement, not one where I had to worry about the market crashing right when I need to withdraw. If you want to set up your own dividend retirement plan, here's how to get started. Number 1, pick strong dividend stocks or ETF. Look for companies with a history of consistent payouts and dividend growth. Think Johnson & Johnson, Coca-Cola, and SCHD. Number 2, aim for a 3 to 5% dividend yield. Too low and you won't get enough income. Too high and it might be risky. Number 3, reinvest and let it compound. The earlier you start, the more time your dividends have to grow exponentially. By following this plan, you can retire without ever selling stocks. So what do you think? Would you rather withdraw from a portfolio or build passive dividend income like I did? Let me know in the comments. Before you go, don't forget to smash the like button if you found this helpful and subscribe for more investing and financial freedom tips. Thanks for watching. See you in the next one.